Hello again. My name is John Kattar and I'm a professional investor. Today I'm going to talk to you about some of the different approaches that investors use to generate returns. First, there is a distinction between active and passive investors. Passive investing seeks to replicate the returns of a particular market. For example, to achieve the returns of the FTSE 100, you could simply buy every stock in that index in the appropriate proportion. But that's an expensive thing to do, so nowadays, most investors use liquid publicly traded instruments called exchange-traded funds, or ETFs, to do exactly that. Active investors take a different approach. They are not satisfied with just the index return and attempt to improve on it by selecting stocks that they think will do better. Of course, investors aren't always quite as smart as they think they are. To their astonishment, they may actually end up doing worse than the index. Between these two approaches, there are hybrid models. For example, some investors may wish to overweight a sector like energy based on their view of the world, but then within that sector, they take a passive approach. Or some may combine a passive approach with a tilt toward desired characteristics, like low price to book. I call this the leaning tower of passive. This approach with the tilt is called smart beta. Most active managers invest in the traditional way by buying a security they think will go up. This is called a long investment. If I buy Exxon, I am long the stock. But it's also possible to make money by borrowing a stock that you think will go down and later buying it back and replacing it, hopefully at a lower price. This is called shorting a stock. Some investors combine the two, hoping to make money on both the long and short books. A book is simply the collection of all positions in the portfolio. Firms that do this are called hedge funds. So how exactly does an investor select securities that will go up a lot or down if you're shorting? There are a variety of ways. One of the most common is what's called fundamental investing, which is investing on the basis of the financial and business aspects of the underlying firm. So these might be earnings growth or financial strength or things like the quality of management or the desirability of a company's products. Sounds logical. Of course, it's worth remembering that other investors are looking at exactly the same metrics. So the trick is to know that earnings, for example, are growing faster than the market expects, rather than that they are simply growing fast. Naturally, given the size of the investable universe, it's very difficult to gain such keen insights. So some investors try to leverage the power of computers. These are quantitative investors, or quants. They may scan financial statements for characteristics they think will lead to big gains, or in today's age of the internet and big data, they can mine a virtually limitless amount of data to look for an edge. Another approach to selecting assets is to focus on the big picture, called thematic or global macro investing. For example, if I think interest rates will decline or the US dollar will rise, I might try to identify those securities that would benefit the most from those changes. Finally, there are investors who just ignore all other data and simply focus on price. Their idea is that any important insights about a stock have already been embedded in the price, and that they can gain an edge by looking only at price patterns. This is called technical investing. Prices can also be compared with the prices of other assets to try to identify temporary anomalies, often with the help of complex computer formulas or algorithms, hence algorithmic trading or algos. Some people take this to such an extreme that they trade hundreds or thousands of stocks in a matter of minutes. This is high-frequency trading. Okay, I hope this gives you some idea of the key approaches to selecting investments that you might encounter. Thanks for tuning in.